company's financial position. It's impossible to go bankrupt if you don't have any debt. I mean, you get the Irving G. Thalberg Lifetime Achievement Award. I think they're bad management. I mean, how could you do that?
2023. What to watch out for in the markets. Some of the world's most powerful investors predict that stocks will rise by low double digits next year, but recovery will take a lot of work. Amid recent optimism that inflation has peaked and that the Federal Reserve will soon begin to change its tune, 71% of respondents in a Bloomberg News poll expect equities to rise, while 19% expect declines. The informal survey of 134 fund managers conducted between November 29th and December 7th included the perspectives of major investors such as BlackRock Inc., Goldman Sachs Asset Management, and Amundi SA. It provides insight into the major themes and challenges they expect to face in 2023, following a year in which inflation, the Ukraine war, and hawkish central banks battered equity returns. So let's find out what experts have predicted to watch out for in 2023. Biggest risks. The biggest threats to potential recovery are intertwined, with investors concerned about persistently high inflation or a deep recession, both mentioned by 48% and 45% of participants respectively. The path forward could be revealed as early as next week when investors are bombarded with headline risks such as the U.S. consumer price data for November and ready decisions and commentary from the Federal Reserve and European Central Bank. Modest gain. Those who expect global shares to rise above a 10% increase in 2023. That is consistent with the MSCI All-Country World Index's average historical return, but it appears modest compared to previous rebounds in 2009 and 2019 when equities gained more than 30% and 20% respectively. Investors are cautious for the start of the year, predicting that the stock market gains will be concentrated in the second half of 2023. Regarding specific industries, respondents generally preferred companies that could protect earnings during an economic downturn. Among their picks were dividend payers, insurance, healthcare, and low volatility stocks. Net energy shortages. Without significant changes in the geopolitical and economic landscape, fossil fuel shortages are expected to last through next winter. Sanctions related to the Ukraine war have reduced Russian supplies, while a blast destroyed part of the Nord Stream 1 pipeline, causing irreparable damage to Europe's energy architecture. It is irreversible because building new infrastructure takes time and money, and ESG mandates make it difficult for energy companies to justify large-scale fossil fuel projects. Meanwhile, demand will only increase once China recovers from the COVID-19 slowdown. The unprecedented growth of renewables and electric vehicles is aided, but there are constraints. Renewables necessitate using scarce elements such as lithium, cobalt, chromium, and aluminum. Nuclear power would relieve some of the strain, but new plants take years to build, and gaining public support can be difficult. Tech rebound. According to a survey, U.S. technology stocks may regain favor after being battered this year as interest rates rose. More than half of those polled said they would invest in the sector. Those in favor point out that despite the recent rally, valuations are still relatively low and bond yields are expected to fall next year, but sentiment is shifting away from a broad buy growth strategy. Instead, many participants suggest being selective when returning to the segment, pulling money on companies with established business models and resilient financials even during an economic downturn. Bonds made a comeback. With interest rates expected to fall in 2023, conditions are favorable for a stable and appealing bond as prices move in the opposite direction of yields. As a result, Morgan Stanley fixed income strategists predict high single-digit returns in German bunds, Italian government bonds, and European investment-grade bonds throughout the end of 2023, as well as treasuries, investment-grade bonds, municipal bonds, mortgage-backed securities issued by government-sponsored agencies, and AAA-related securities in the United States. On the other hand, investors should keep a close eye on quality. High-yield corporate bonds in the United States may appear appealing, but they are not worth the risk during a potentially prolonged default cycle. Securitized products, on the other hand, such as mortgage-backed securities, auto-backed securities, and collateral debt obligations, may provide income opportunities. Spreads, or the excess yield over low-risk government bonds with comparable maturities, are at their widest since the pandemic. Meanwhile, rising interest rates limit the supply of new securities entering the market. This is especially true for mortgage-backed securities issued by government agencies. In mid-23, markets will go risk-on. Investors should be long bonds, particularly 30-year treasuries, during the first half of 2023 as a recession and credit shock hammer risks assets. The fact that the S&P 500 typically bottoms 6 months before the end of a recession suggests a rebound will begin around mid-year. As BofA anticipates new lows for U.S. stocks in the first half of next year, chief investment strategist Michael Hartnett reiterated his oft-repeated recommendation for equity investors: nibble at S&P 3600, bite at 3300, gorge at 3000. Oil prices could remain high for a longer period of time. Russian sanctions, low oil inventories, China reopening, and an OPEC willing to cut output if demand falls keep energy prices high. Brent crude should average $100 per barrel in 2023 and peak at $110 in the second half, said Francisco Blanc, head of global commodities, equity derivatives, and cross-asset quantitative investment strategies. Trends point to high-yield equities. On the other hand, equities are expected to remain volatile in the coming year, with the S&P 500 ending roughly where it began at around 3,900. We believe consensus earnings estimates are simply too high to the point where companies will hoard labor and see operating margins compress in a very slow growth yield economy, Wilson says. To that end, investors should look into higher yielding sectors of the stock market, such as consumer staples, financials, healthcare, and utilities. European equities offer a modest upside with a total return of 6.3% expected through 2023 as low for inflation pushes stock valuations higher. This should eventually make the offset on 10% drop in earnings per share we expect from weaker top-line growth and material margin disappointment, says Graham Secker, head of European and UK equity strategy. Industrial materials are on the rise. Copper prices in particular could rise by 20% next year. Key market recessions are a headwind, but China's reopening, a rising dollar, and most importantly, an acceleration of renewables investment means more than offset half of those negative factors, said Michael Widmer, senior metal strategist. Reshoring of manufacturing. Supply chain disruptions caused by the pandemic and Russia's invasion of Ukraine could be fueled a major desire of major economies to zero stone production. While this could benefit domestic growth in the long run, it requires investment, time, and the ability of skilled labor. In short to medium term, reshoring jobs from low-cost offshore locations will drive up wages for skilled workers while reducing corporate profit margins in high-income countries. Transition to the commodity-driven economies. The same disruptions that sparked the reshoring trend have prompted countries to seek the safer and greener raw material supply chains either within their own borders or those of allies. Mining for critical rare earth elements has been outsourced recently to countries with abundant cheap labor and lax tax regulations. As these processes move to high tax and high wage jurisdictions, raw material sourcing will need to be rethought. This will increase exploration investment in some countries, and those who are unable to source commodities locally may find themselves shifting trade alliances. We expect such alliances to reflect the geopolitical shift from a unipolar to a multipolar world order. For example, many countries in the Asia-Pacific region will become more likely to prioritize China's agenda over that of the United States, potentially limiting U.S. access to commodities now sourced from Asia. Persistent inflation. Inflation is unlikely to slow anytime soon given those pressures. This presents a significant challenge for central banks and the preferred tool for price control, interest rates. However, higher borrowing costs will have a limited impact now that we have entered a period of secular inflation with the unraveling of supply-demand imbalances caused by globalization. Previous inflationary cycles ended when prices became unaffordable, resulting in a drop in demand. When it came to discretionary purchases, this process is simple, but it becomes complicated when it comes to necessities like energy and food. Because consumers and businesses have no choice but to pay the higher prices, there is little room for price relief, especially since many governments subsidize consumer purchases of these staples. What do you think of these things to watch out for in 2023? Let us know in the comments below and subscribe to our channel for more such videos.